Tom Wheelwright, CPA for Robert Kiyosaki, author of Tax-Free Wealth.
And I'll never forget, Robert looked at me and he goes, "Really?" I said, "Yeah." He goes, "Whoa. The government's greatest power is the power to tax. The reason the dollar has value is because you pay your taxes in it."
Interesting.
If you were not required to pay your taxes in dollars, it would lose all its value. Now, let's get to the worst of it.
From your perspective, what is your thoughts on using life insurance as an asset?
It's fascinating when you write a book and you discover things you didn't know. And what I discovered was business is the #1 tax incentivized investment in every country. So the government literally will pay you to start a business. If you wonder, why did Elon Musk not pay tax for 20 years? Or why did Amazon not pay tax for 20 years? It's because of this.
Tom Wheelwright, CPA for Robert Kiyosaki, author of Tax-Free Wealth, and author of another book that I'm going to promote heavily in this interview. Welcome to the show.
Hey, thanks so much, Caleb. So good to be with you.
You know, this is one of those come full circle moments. I remember seeing you speak when I was 19 years old, and I was so inspired. And I love how you showed up. You actually made this whole idea of taxes like somewhat fun and exciting for me to want to pursue.
Cool.
And obviously, anytime I'd ask people like, what's been the #1 book that's impacted your life? It's either the Bible, Think and Grow Rich, or Rich Dad, Poor Dad. And I interviewed another person yesterday, and their whole journey started with Rich Dad, Poor Dad. So you have Robert Kiyosaki, who's probably the most iconic, well-known person in the space, wrote one of the most successful books that have changed so many people. And he's not only written a foreword for one of your books, you are his CPA. You've traveled the world with him on stage. And so it's just an honor to have you be on the show. It's been an honor to get to know you. You've been so kind to even come out to my latest event and get to speak. And I remember when we connected, it was like 6 months ago. I remember speaking after you, and it was probably one of the most nerve-wracking talks I've ever given. I was like, I hope you just leave the room. But the fact that you were in the back of the room, I was like, I had to make sure I didn't mess up too bad. And so overall, Tom, thank you for being on. And I'm grateful that you're on the show.
Happy to be here. And you did great.
Okay. So we could go a lot of different places. I think what I would like to start with is we're recording this August 22nd. And there's a lot of crazy things happening with the election. You have Donald Trump on one end. You have Kamala Harris, who should be accepting her nomination for the Democratic Party tonight. And she's opened up her mouth on a couple things. And I would love to hear your thoughts, current events. And then what I would like to do is go back and talk about some of your frameworks as it relates to tax. You wrote an amazing book that is not as known as it should be. And I would love every single one of the people listening and watching this to go get your book. And I would love to dive into your newest book. And you even have a section on life insurance. A lot of the people that follow this podcast and YouTube love when we talk about life insurance. So I'll definitely ask you that as well. So welcome to the show.
Oh, thank you. So yes, Kamala should probably stop opening her mouth when it comes to economics, because first of all, what got Venezuela to where it is price controls. Price controls are basically what dictators and communists do. It is a very bad policy. So, and to blame it on, especially grocery stores, I'm going, nobody takes it in the shorts on inflation like grocery stores do, because they can never stay ahead, right? Their prices go up faster than they can raise prices. And so I think that's bad. But this thing on unrealized capital gains. So can we just talk about this for a minute?
Absolutely.
Because Joe Biden, now we have to assume, for whatever, Kamala Harris is actually making it worse than Joe Biden did, but we have to assume that what she hasn't said, she'll pretty much follow what Joe Biden, what the Democrats put in the budget for 2023-24. So this year's budget. And I want to just kind of walk through, just stay with me and walk through exactly what happens on capital gains. Okay. So first thing they want to do is they want to raise the capital gains rate from a maximum of 20% to a maximum of 45%. And the first question people go, well, wait a minute. I thought they want to just raise the rate to 39.6. Yes, but they also want to impose the Medicare tax and raise it to 5%, and they want to impose it on capital gains. So that means that you're at 45%. You add another 5% for your state, which you probably have, you're at a 50% tax rate on capital gains. All right, so think about this. Your home goes up in value. You sell it and give 50% to the government. Your stock options from work go up in value. You sell them, you give 50% to the government. Your jewelry goes up in value. You feel I have to sell it now. You've got 50% capital gains. But here's the worst one. You're a business owner.
Yeah.
And you've put your entire life savings into your business. You've decided, you know that that's your retirement. And you didn't do a 401k because you put your money into your business so that you could serve more people. Okay. So the promise was when you retire, you'll sell your business and you'll pay capital gains taxes, 20%. So instead, what's going to happen is you're going to sell your business and you're going to pay 50%, not 20%. Now, let's compare that to the average employee. Average employee puts their money in the 401k. They're taking out, let's say that they're both going to live on $200,000 a year. The thing is, the employee is going to get taxed at roughly 20% because that's the average rate at $200,000. But the business owner is going to get taxed at 50% because it's all in 1 year. And you can't prevent that. You can't sell a business on an installment sale. You're going to sell the business. The buyer wants to pay you now. They don't want to wait to pay you. Okay. Now that's the capital gains.
Now, just a question for you. Is this one of these, like you have to be worth $100 million?
No, this is so right now. Okay. We'll jump to that. But right now it's $1 million. So for a business owner, you're absolutely going to sell your business for more than $1 million. I mean, your average employee, if you've got $200,000 a year of 401k money, you've got more than $1 million in your 401k. But now what's going on is you're going to have capital gains. Let's say you sell your business for $5 million, $4 million of which you're going to pay 50%.
Wow.
So it's just $1 million. Okay. But keep that in mind because remember that when the income tax came into effect in 1913, it was only a 7% rate and only on the 0.001% of the population. Okay. And now it affects over 50% of Americans.
Yeah.
All right. So just keep that in mind.
So you're saying just because whatever they say today, it's one of those things.
It'll be that today, but here's what happens.
Yeah.
It's way easier to lower the threshold.
Correct.
Than it is to raise the rates in the first place.
Correct.
Okay. So it just becomes easy because politicians have never seen a dollar of your money that they didn't want.
Yeah, that's right.
Ever. Right.
Yeah.
It's like they look at taxpayers. I swear, at the convention this week, they're looking at everybody in the eye and say, is that my money in your pocket? And that is certainly the way the Democratic Party is certainly looking at it. Absolutely.
So Tom, just to reiterate what you're saying, it would be easier to say, hey, we're gonna pay, like, let's say this 45% tax is gonna trigger on $1 million bucks.
Right.
And then what could happen in the future, not that you're saying this, but they could lower that to 250.
Right.
They could say we didn't change the rate at all.
Exactly.
But you brought in more revenue, you made more people.
Well, here, from a policy standpoint, here's the worst part. They won't raise revenue. It doesn't raise any revenue. When you raise the capital gains rate, you actually lose revenue.
Yep.
Because people stop selling. So let's take that example. Let's say you go, well, instead of selling my business, I'm just going to give it to my kids.
Yeah. Guess
what? Under Joe Biden's plan, a gift would cause capital gains tax. Okay, so now you're paying 50% even though you have no money. Now instead you go, well, okay, well then I'll just wait until I die. Oh, but under the Democrats' plan, you'll pay 50% capital gains tax when you die, plus 40% estate tax. So you'll pay 90%. So your kids get 10% of it. Okay, so you go, all right, well, here's what it is. I've got this office building, and I'll just sell it for my retirement, and I'll just get a different kind of building, like a Walgreens or, something that just pays me a monthly check, right? I'll do that. Well, right now, that's tax-free, right? That's called the like-kind exchange or 1031 exchange. Not under the Democrats' plan. Under the Democrats' plan, that's taxable, subject to 50% capital gains tax. Okay, now let's get to the worst of it. The worst of it is, okay, you know what? It's too hard. I'm just going to hold on to it. Now we have an unrealized capital gains tax, also 50%. Okay, so now we're going to have an unrealized capital gains tax. All right, let's think how bad this unrealized capital gains tax is. First of all, it's probably unconstitutional, but we don't know that for sure because there are actually provisions in the law that allow for unrealized gain to be taxed. There are a couple of provisions in there. So it's not as clear as some people think it is. But let's say, okay, your business goes up in value. Now you have to get an appraisal, which runs about $30,000 for an appraisal. I have to get appraisal every year. I have to pay for that. The IRS doesn't pay for that. I pay for that. And you're going to tax me on the increase in value, even though I got no more money and I already paid tax on the income. And the only reason I increase in value is because I made money. But you tax me on the income. So now you tax me also on the increase in value. Okay, so you go, well, wait a minute. What else? Well, your jewelry goes up in value. You're not selling it. These are heirlooms. This is your grandmother's wedding ring. And this is an heirloom. It goes up in value, capital gains tax. Okay, or your home goes up in value. Your home goes up in value. Guess what? Capital gains tax. Now, the naysayers would say, well, wait a minute, that's the billionaire's tax. Okay, well, let's first of all specify that it's not a billionaire's tax. It's a tax on 100 million. And for those, clearly, the Biden-Harris administration cannot do math because you called it a billionaire's tax and it's on people making a tenth of $1 billion.
Well, and just to be clear,
$1 billion.
It's not making; it's a total net worth.
Yeah, and it's net worth, right? Yeah, but still, it's not a billion. Okay, a billion is one more zero,
right,
than 100 million. So 100 million is 1/10 of $1 billion. Now, how long will it take before that 100 million becomes 10 million, becomes 1 million? And you go, well, 1 million, that's still a lot. I'm going, wait a minute. Your IRA could be more than $1 million. When your IRA goes up in value, are you going to get an unrealized capital gains tax on your increase in your IRA value? Potentially you are. So this is really, really bad policy. It's very hard to administer. Are you going to get an appraisal on your jewelry every year? You're going to get appraisal on your home every year. Who's going to do these appraisals? I mean, it's completely unworkable. You know, France, Europe has done this before. They've tried this. France did it. Everybody, the rich people just moved.
Yeah. Now
you can't do that in the U.S. You can't just move. We're taxed on worldwide. So you can't just move and get out of there. You got 10 years before you have, even if you give up your citizenship, the U.S. can tax you for 10 years. So it's not that easy. Okay. However, the administration of it is horrible. It would literally just one of these proposals would have a really big negative impact on the economy. Think about just getting rid of the like-kind exchange. You'd eliminate the liquidity in the real estate market, basically. You decimate it, especially if you combine that with a 50% capital gains rate. Now you said, okay, nobody's going to sell. You think it's tough to buy a house now? Wait until you get a 50% capital gains tax. Nobody's going to sell. Nobody's going to sell their house. You're not going to be able to afford to sell your house.
Yeah, that's it's very, very concerning. And you wonder, why do you think this was even floated? You would think if you were a political strategist, you'd just be like, hey, why don't you not say anything? Like, why don't you just take a moderate position? Because everyone's going to vote for you regardless. Like I'm just wondering, like, I'm glad these things are being said, because at least
I'm glad finally people are starting to talk about tax.
Yeah.
And there's about a $10 trillion difference between the two parties.
That's
$10
wild.
trillion. I mean, that's not a billion, by the way.
Yeah.
That is a lot. That is 1,000 billion. Just 10 trillion is 1,000 billion. Yeah. Actually, it's 10 trillion is 10,000 billion, right?
It's crazy.
It's 10,000. I mean, it's like, how can you even think these kinds of dollars, right? But here's what happens. There's this, and really, I will say that AOC started it. She really did. She was the one, she wore the dress, tax the rich. There's this whole thing. And honestly, I think the very wealthy are somewhat to blame for this, okay? Because they have not, it's not that the average person is making less money. The average person is not. The average person is doing better now than they did 20 years ago. But the rich person is doing even better than that. And that's just compound interest. I mean, you talk about that all the time, Caleb. I mean, compound interest, the more wealth you have, the bigger the compounding, right? So of course they're going to have more money. And of course, all the policies during COVID was really the effect was it all got more money to the wealthy. And so what happens is that people have this idea, well, it's okay to tax the rich because I'm not one of the rich. Everybody is good with taxing somebody else's money.
That's right. When
it starts affecting them, they get upset. But here's the reason they've been able to get away with this dialogue. Well, it only affects people making more than $400,000. Well, by the way, that is fundamentally false. Let's take the idea of increasing the corporate tax rate to 28%. Well, you think that's not going to affect the value of the stocks in your 401k portfolio? Of course it is. You think it's not going to affect the amount of raises that they give to the employees? Of course it does. And there's really good data on this. I mean, this isn't supposition. It's been done before. We know what happens. So I think there's just, it's a really interesting, it's actually why I wrote Win-Win Wealth Strategy. I wrote this book specifically because of this, because I don't like the dialogue. Would I have a problem with Hillary Clinton's proposal of a 4 or 5% surtax over $10 million? Honestly, I would have no problem with that. I don't even have an issue raising the rate from 37% to 39.6%. It probably should stay under 40% for, the middle class, upper middle class person, because they take that extra money and invest it all. And they don't typically invest just in the stock market. They're typically investing in a business. They're typically investing in real estate. They're typically investing in real assets, hard assets. The very rich, they have to put their money in the stock market or the bond market, because there's nowhere else they can put it. Yeah. Right. It's easy to invest $1 million. It's really hard to invest $100 million. So the only place is in the markets. And so I'm not against tax, and I'm not against adding a surtax for a certain level of income. I don't have an issue with that. I really don't. I think the taxes on the very wealthy are maybe a little understated right now. However, what we have to recognize is that the effect, if you tax the investors, then what happens is that money doesn't go into investment. Yeah. Here's what happens to it. So interestingly enough, so in Biden's budget this year, the tax increase would have been $5 trillion had he got what he wanted. The spending increase is $4.5 trillion. So the issue to me, it's bad enough the tax increase of $5 trillion, but the bigger issue is the $4.5 trillion. Where is that money going to go? Well, okay, people go, well, that means that it's going to be done in transfer payments, child tax credit, et cetera, et cetera. Okay, and where are you going to spend that money? I'm going to spend it on Amazon. Who owns Amazon? Jeff Bezos. So it always ends up back in the pockets of the wealthy, right? You can't stop that. It's always going to end up back in the pockets of the wealthy. So you go, okay, but at least in the meantime, I get to spend it. Okay, but you're going to cause inflation. I mean, $4.5 trillion, to blame, going back to price gouging and price controls, to blame the retailers for inflation. Are you kidding me? That's like blaming the victim for the crime.
And also companies are not just going to lose money. So it's like, you can say all you want. You can say they're evil by raising their prices. Why don't you tell them they can't raise their prices? See what happens. Like this has happened in history. And I don't think point to one example where this was like, this was a great move. Our economy is way better because of this.
This is exactly what's going on in Venezuela right now, right? They put price controls on. And then what happens is then, okay, so you have shortages. And if I have shortages, I'm going to get in the black market. That's what I'm going to do.
Before we jump into your book, the Tax and Jobs Act is going to be sunsetting in
2025 and 2026.
That's a big deal. And it's my understanding that if a Republican, if Donald Trump gets in the office, he's going to continue that. And then if a Democrat gets in office, they're probably going to just let it expire.
Well, again, it's not just the president that matters, right? Congress matters. So I actually think the congressional elections are at least as important as the presidential election. Let me put it just a slightly different way, if I could, Caleb. If the Democrats sweep, in other words, they get a majority of the House, the Senate, and the presidency, then yes, I would expect anywhere from a $5 to $10 trillion tax increase. That's what's going to happen. If the Republicans sweep, what'll happen is that you'll get probably something of an extension of the 2017 tax law. And there are some really good provisions. By the way, the corporate tax rate does not sunset. That's the only thing that doesn't sunset. So even if the Democrats sweep, they would actually have to convince all of the other Democrats to vote for an increase in corporate income tax, even though it seems like a good idea because all those bad corporations, corporations are not people, right? So your pension plan owns that stock. You may own some of that stock. I mean, yes, there are foreigners who own that stock. You're exporting the tax at that point, but it does affect competitiveness. But we would expect, we kind of expect which is effectively a $2 trillion tax decrease. It's not really, because it'd just keep it the same. They keep saying it's a tax decrease. It's not really a tax decrease. It would just keep it going is what it would do.
If it did sunset and expire, are we talking what would be different from a standpoint of, it's my understanding that 1031s would look different. It's my understanding that even life insurance and annuities could look different. Let's talk about the big provisions.
Okay. So one thing that the people on the coasts would like is that the non-deductible state and local taxes, they'd be deductible again. But so would we get the alternative minimum tax back. So just so you know, that's all a fallacy to the state and local deduction, because nobody really got it because of the alternative minimum tax. We got rid of the alternative minimum tax and we got rid of the deduction. It was pretty much a wash. And then we raised, by the way, the standard deduction, go back down. the rates go back up. Bonus depreciation goes away. The 20%, the biggest one is the 20% business tax deduction goes away. And that's huge. If you look at the numbers in the 2017 law, so there was a $1.5 trillion deficit in the 2017 Act. Okay. $1 trillion of it came from reducing the corporate income tax rate, and 500,000 came from the 20% small business deduction. So if you were to do so you do have $500 billion of potential revenue increase by eliminating that 20% deduction. So that's a big one. That's actually, I think that's probably the biggest one. I think that's one of the best provisions because it's such an encouragement to small business to have that 20% deduction. And it was really a quid pro quo. You know, you vote for the corporate tax decrease, rate decrease will give you a business tax decrease.
Well, and Ken Keyes, who is one of the people that helped get that through, it was almost like, hey, if we're going to help the corporations, we should at least pass down some type of benefit to the small business owner.
Yeah, so Marco Rubio was heavily involved in that.
Yeah, thank you, Marco. All right, let's get into your newest book. Maybe before we jump into that, Tax-Free Wealth, over 400,000 copies sold, which is remarkable. If you don't, majority of people sell, what is it, less than 1,000?
Less than 1,000, yeah.
Less than 1,000. They go through all the work.
People sell over 5,000 copies. We sell 5,000 copies a month.
So you guys are like, obviously when people think taxes, you're the number one person they think of, period. Period. If you start doing research, you're the guy that is the person that's known for like being the godfather as it relates to being this guy. And a lot of people have used your book to come up with probably some crazy TikToks that make you want to throw up in your mouth. But with all that said, why don't you just give like the framework of that? But then I really want to talk about a book that maybe not everyone has associated with your name. And I think there's some things that you write in here that are remarkable.
Thank you. So tax-free wealth. So there's 3 questions that you need to ask yourself, or your tax advisor should be asking you. The first question is, how do you make your money? That has a big impact on on what you can do from a tax standpoint. That is the basis of tax-free wealth. Tax-free wealth, the whole idea behind tax-free wealth is it's a paradigm shift from the tax laws out to get you to recognizing that the tax laws is a series of incentives.
Yeah.
And primarily for business owners and investors. Okay. So which is how I ended up traveling the world with Robert Kiyosaki, is because he goes, in fact, I remember where I was. We were on stage at the Paris Hotel in Las Vegas, and we had about 200 people in the room, and I'm on stage with Robert. And I said, well, you know, the tax laws, this is back in, this must have been 2010, 11. And I said, the tax law is really a series of stimulus packages, because that was the big term right then, right? We had all these stimulus packages coming out. It was really a bunch of stimulus packages for business owners, investors. And I'll never forget, Robert looked at me and he goes, really? I said, yeah. He goes, whoa. And that was the big shift for him. And he goes, oh, well then everything you're talking about supports what I do. I said, yes, everything I talk about does support what you do. And, that's when we started going on the road. But tax-free wealth really walks through the fundamentals of the tax law and what those incentives are. And that's the point, is to make it simple, make it easy to read. I have 2 favorite reviews of tax-free wealth. One is, it read like a spy novel, which I worry about that person. And what spy novels they're reading. But the other one I've actually had more than once, which is, it was a great beach read. And to me, that's the best one, because it should be easy enough for anybody and enjoyably enough that you could read it on the beach. Yeah. And that's really what tax-free wealth is. Like I say in tax-free wealth, if you want to change your tax, you have to change your facts. And that's probably the quote that I'm known for in tax-free wealth, because the idea of tax-free wealth is to give you a choice. If you understand how the tax law works, and you understand that I can change my facts and lower my tax by doing that, then my decision is, do I want to change my facts?
Yeah.
But if you don't know that, you have no choice. You just have to pay high taxes. So that's really the fundamentals of tax-free wealth. It's really a series of incentives, and here's what they are, and it lays it out, and it really focuses on business owners and investors.
I remember when you spoke, and this still, like, to this day, you talk about like this treasure map and the concept of like trying, like looking, instead of saying, hey, I want to like just like be against the government, almost thinking like the mindset of like, why does the government give incentives? Why would they do? Well, why does potentially real estate have benefits? Well, think about it. If the government had to build it themselves, I mean, have you ever gone to the DMV? Like, probably wouldn't have been done as good as what the private market could have done. And so they'll give the incentive, but it's not just like they're trying to bail out wealthy people. They're literally saying, this is better for the people. And so instead of us building it ourselves, you're doing something that's benefiting society, and it would be cheaper for us to give an incentive to you than for us to build it ourselves. And I think, again, it's like, that's obvious to you, but I think there's a lot of people that don't connect the dots. And when you start understanding that of like, and again, I'm sure the stimulus was like when Obama was in office, and you know, things, that is a great example of like, there's money out there, go get it, but we got to figure out ways to provide value to get that. And so love that. And I think that for me has been a really big paradigm shift.
No, I appreciate that. So the second question that you have to ask yourself is, what are you going to do with your money? And about 20 years ago, I started doing serious tax strategy work. I'd always done tax planning, but it was more reactive, but really tax strategy where you're doing a plan of action for reducing your taxes. Well, I started doing that. I always ask the question, how do you make your money? That made so much sense to me. But then I would ask the follow-up question, which is, what are you going to do with your money? For entrepreneurs, business owners, what I found was 95% or more of them, the answer was, I don't know.
Yeah.
I don't know what I'm going to do with my money. I don't know, not just the money when I sell my business, but the money that I make in my business that I don't have to put back in my business. Right. What are you going to do with your money? And so we actually came up with a whole process for deciding how to do that. You know, what to put your money into. We're not wealth advisors, but we are wealth educators. And so, our CPAs actually walk people through how do you figure that out? But it's that second question is more important than the first question from a tax standpoint, because what you do with your money has a bigger impact on your taxes than how you make your money. And so a lot of, for example, financial advisors, they say, well, we do tax efficient investing. Well, what that means is that you're paying less tax on the money, on the earnings from your investments. That's okay. How do you make your money? What Win-Win Wealth Strategy goes through is 7 investments that if you make that investment, not only will you not pay tax on the income, but it'll actually reduce your taxes from other income, like your business or your job. And the idea is, well, everybody who got their first paycheck and looked at their pay stub and they go, well, wait a minute, how come my check, I'm supposed to make $10 an hour. How come I only got $8 an hour? And they go, who the heck is this FICA person? Yeah. Right? Yeah. And immediately they realize, and typically you're 16 when you do this, right? 16, 17-year-old, you get your first job. You go, wait a minute, why don't I get all my money? And what happens is that you all of a sudden realize, hey, I have a partner in my job. I have a partner in my business because the government, they're my partner. And so I actually embraced that in Win-Win Wealth. And I said, look, the government is your partner. Now, here's your choice. You can be a silent partner and just go ahead, pay your tax. Don't worry about it. Or you could be an active partner, do the things the government wants you to do. And not only will you pay little or no tax on the income from those investments, but you'll actually pay little or no tax on the income that you used for those investments. Yeah. Right. And that is, so I think of Win-Win Wealth Strategy as it's an investment book. that shows you what are the tax not efficient investments, but the tax effective investments.
Is it fair to say, Tom, that your first book was like, okay, we're gonna show you the basics of like when you make money, how to keep more of it. And then once you have the money, now you're like the best way to grow your money with the same principles of through looking through incentives.
Exactly. Now, here's what was interesting is I discovered as I wrote the book is it's fascinating when you write a book and you discover things that you didn't know. And what I discovered was that of the 7 investments that the government highly encourages, they'll literally pay you to make, 6 of them, the government makes more money by giving the incentive than if they didn't give the incentive, because they encourage the business activity. They encourage the activity. There's one that doesn't, and that's the one that everybody's okay with, which is the retirement plans. Retirement plans, the government breaks even. Retirement plans, it's a break-even proposition for the government. Business, real estate, agriculture, energy, those are all the government makes money. Okay. The government's going to make money from that. Even life insurance, the government's going to make money as a result. Okay. Because that money is going to be invested. Right. And then there's going to be some tax liability at some point. There is some tax liability at some point. But with retirement, they just break even. So that's why it's the win-win, because it's a win for the taxpayer and for the government. I think that's the mistake, that's the lack of information people have, and why they say, let's tax the rich. Because the problem is that if you were to take these incentives away, then let's make a perfectly good example of this. If you didn't have the tax credit for electric cars, would people buy electric cars? Yeah, some would, but not as many. If you didn't have the tax credit for solar panels, would anybody put on a solar panel? And the answer is no. Nobody would do it, because without the tax benefits, it makes no economic sense. You would never, ever do it unless you just said, well, I want it to be good for the environment, and I think that's good for the environment. But that's like charity. Right. That's you're basically donating money to the climate, if you will. Okay. And that's fine. I have no issue with that. But the tax incentives, what's interesting is it doesn't matter which side of the aisle you're on.
Yeah.
You love tax incentives. The government's greatest power is the power to tax. And in fact, little known fact, the reason the dollar has value is because you pay your taxes in it.
Interesting.
If you were not required to pay your taxes in dollars, it would lose all its value. That's what gives it its value in the first place, because you're required to. By law, you have to use dollars. That means you have to earn dollars. Yeah. Okay.
The same thing with debts, by the way. You have to, if someone owes you money, you have to be able to accept it in dollars. If not, the debt's canceled.
Interesting. Yeah. Interesting. So back to the win-win wealth strategy. The whole idea is that, look, this is not a bad thing. This is a good thing. I don't think all incentives are good. Okay. That would be crazy. But these primary incentives, they're not just good public policy wise, but they actually are good for the Treasury. They actually increase the Treasury for sure. Okay,
so if you're cool, I would love to go through these items quickly. Sure. And again, we will have a link in the description wherever you're watching this or listening to this. Please go get this selfishly. Like, if you can have the mindset of how you keep more of your money, and then what you should be, like the frameworks of how you should be investing, you will thank yourself if you go do that. And obviously take 10 seconds and write a review after you get it. It helps everybody. Please. So when it comes to, the first investment is business. Pretty self-explanatory, I would believe. But I just want to let you unpack. Business is first, technology is second.
Yeah, most of the incentives. So of the 7 investments, 5 of them depend on business of some sort. Okay, 5 of them depend on business of some sort. So what's interesting is, so we looked at 15 countries and how do these incentives compare from country to country? Because I want to know, is it just the US?
Right.
Because people tell me because I've traveled all over the world. I've been in Kazakhstan, for heaven's sakes. And people ask me, well, they say, well, that works in the US, but don't work here. I'm going, I'd like to know, does it actually work, in not Kazakhstan, but does it work in, does it work in France? Does it work in England? Does it work in Australia? Does it work in Japan? And the answer is, yeah, business is the number one tax incentivized investment in every country, 100%. So it's not a U.S. thing. And obviously there's good reason for that, because business owners don't pay tax on their total income. They pay tax after deductions. Yeah. Employees pay tax on their total income. They get no deductions. So that is the big difference. But what I illustrate, and what was interesting, because I had not run these numbers until I wrote the book, you can start a business in your home, and the tax benefits of starting the business are often greater than the cost of starting the business. So the government literally will pay you to start a business. Literally. I mean, absolutely literally, because you've got income from somewhere else you wouldn't be starting a business, right? So that income, the tax savings on that income are greater than the cost of starting the business. And only business has that kind of a more than 100% impact.
Well, let me add, another way of saying that is you have to try to make money. So you start a business, you have a W-2 over here. You started a business, not super profitable. You're not making very much money, though you're trying.
You're losing money the first year.
You're losing money, but you're able to make some deductions, and you're able, that lowers your tax bill across the board. Right. And so that's an example of that. Let me ask you this, Tom. There's a lot of people in our circles that invest in their business, but it's it's like, when do you tell someone to be like, hey, your investment, you're delusional. Like, stop investing in your business, invest in other things. Because it's easy to say, but how do you know when you get to a point when you're like, you should stop investing in your business because the returns are not what they could be?
Yeah. And that's what you have to look at I always tell people, run the numbers. Okay. As long as the return on the business is, and most of the time it is, by the way, most people, as long as they can reinvest in their business, as I'm talking about a profitable business, as long as they can reinvest in their business, that's probably a higher rate of return than any other investment for them. That is typical. Normally, I mean, you can 80, 90% returns on your money are not anywhere unheard of in business. They are unheard of everywhere else. Yep.
I'll use myself as an example. Where I'm at financially would not have been possible if I just took my $5,000 a year at, put into my Roth IRA. Nothing against the Roth IRA. It's just my whole life is radically different. And it's because I've invested my time and energy in the thing that has given me the most leverage. And so a great example of that. What do you mean by technology? And you say research and development, that would be investment number 2.
Right. So those businesses that invest in developing new technologies, new ideas, they end up paying very little tax. I mean, if you wonder, why did Elon Musk not pay tax for 20 years, or why did Amazon not pay tax for 20 years? It's because of this. It's because the U.S., like most countries, incentivizes investing in research and development. Now, interestingly enough, going back to the 2017 law, there's a provision in there that actually we would love it to run out, because we lost some of the benefit of research and development, and it's a very bad law. It's actually a very bad law, and we actually incentivize research and development less than most countries.
Interesting.
France incentivizes it more. South Africa incentivizes it more. So most countries incentivize it, and most of them incentivize it more than the U.S. does. But it's big enough. One of the big ones is, if you lose money in your business, you get to use that loss the next year against your business income.
Yeah.
That's actually a big deal because, a company like Amazon, it lost money for many years before it made money. Same with Tesla, lost money for many years before it made money. Well, you don't want to be putting the brakes on those businesses and their growth. And if you taxed, if you didn't allow that loss to carry forward, you'd actually put heavy brakes on the business because they'd have to come up with money to pay taxes, even though they'd been losing money. And so what the government's doing is I always tell people that the job of our CPAs and our franchise is to raise capital from the government for business owners.
There you go.
That's our job.
That's good.
Our job is to raise capital from the government for business owners. And if you look at the research and development area, that's exactly what it's doing. It's allowing that capital to be redeployed without the burden of taxation.
Is it possible to invest in this if you don't have the business underlying? Like, could someone listening to this who doesn't have a business?
Well, you can invest in somebody else's business.
Okay.
Sure.
That's fair.
Yeah, absolutely.
And then that utilizes this. So the third investment is real estate. I mean, this is something that we could probably talk for a whole day on. So what would be your
but let me be really clear.
Yeah.
We're talking about long-term rental real estate, not fix and flips, wholesaling, that kind of stuff. We're talking about investment real estate. That's the investment. So whether it's residential or commercial or industrial, doesn't matter. Frankly, the tax benefits are similar from one to another. Low-income housing does have some extra benefits to it. And in fact, the low-income housing tax credit is purported to be the most important driver of low-income housing being built. And one of the reasons we don't have enough low-income housing is because there's not enough tax credit there, because that's a very high-risk proposition to build low-income housing. And so but the low-income housing credit can be as much as 70% of the cost of the project.
Wow.
Yeah, over the lifetime. So it's a pretty big number. And so real estate has obviously enormous tax benefits. But remember, in order to get that, you really need to be in the business of real estate. So it starts with business still. And then, so the nice thing about real estate, you get the business tax benefits and the real estate tax benefits.
Yep. And it's one of the few asset classes that you can get leverage easier than others.
Right.
And so
it's easy. Banks like to lend money on real estate.
And I don't know if this is when we should talk about it, but you have this concept of buy, borrow, die. And I think it's interesting when we talk about life insurance. It's interesting when we talk about businesses and what Elon and those are doing, but also with real estate.
Yeah. So buy, borrow, die is it's kind of like playing Monopoly, right? 4 greenhouses and then 1 red hotel, right?
Yep.
So I like the idea of the 1031 or the like-kind exchanges where you start out small in real estate. You buy the small houses or small investment properties, and then you exchange them as they get more valuable and you get more experience into the larger property, say multifamily. And then eventually you're going to exchange it into something like a Walgreens or a Safeway or a Walmart, where that's a sale leaseback. They sell you the building and they lease it back from you. And you get mailbox money, right? And then eventually you die. Well, so the question is, how do I avoid tax all the way? Well, first of all, we're going to do the like-kind exchanges. That avoids the tax during it. Well, but what if you you need money? Well, okay, you're going to get the income from it, and that's money. But the other way you can do is you can always borrow against it, right? That's the leverage you're talking about. So you borrow, and borrowing is not taxable because you have to pay it back.
Sure.
Then when you die, in the law as it is now, not in the Biden-Harris law, but in the law as it is now, when you die, that capital gains tax that you would otherwise owe goes away. It's called a step up in basis, and it goes away. So buy, borrow, die it's a brilliant strategy because you literally take what would normally be a temporary tax savings in depreciation and you make it permanent.
Yep. The investment number 4 and 5, you have energy and agriculture. And so why don't you unpack that quickly?
Well, so energy, interesting, is in the US, it's both renewable energy and fossil fuel energy. They're both highly tax incentivized. And in fact, if you put, now, the nice thing is it actually builds. So solar energy is nice because it's best if you put it on your office building. So if you own real estate that's investment, so you're using that investment, and then you put solar panels on it, not only do you get a 30% credit, but you actually also get the depreciation deduction.
It's amazing.
So literally the government will contribute over 50% of the cost of those solar panels and batteries. And I've done it on my properties, and of course I live in Arizona, so we get lots of sunshine, and our electricity bills in the summer are really high. So solar energy makes all the sense in the world in Arizona, and when the government's paying 50 to 60% of it, why not? So that's the solar side. On the fossil fuel side, interestingly enough, it's investing in oil wells. Oil and gas wells. Now, again, not Exxon stock, oil and gas wells. But if you invest directly in the well, you get what's called intangible drilling cost deduction, and it'll be up to 80% of your investment the very first year. And so if you put in $10,000, that's an $8,000 deduction. Well, the difference here between fossil fuels and real estate is that in real estate, there are things you have to go through in order to get those deductions. Like being a real estate professional or having passive income, things like that. That does not apply to oil and gas. So oil and gas has a carve-out exception that even if you're an employee, you can take the deduction.
Interesting.
Even if you have nothing to do with the oil well, you just invest, you can get the deduction. So there are, I will tell you, the biggest investors in oil and gas are probably doctors.
Interesting. And let me ask you this. Obviously, neither Tom or I are giving tax or investment advice. Don't sue us. That sounds great. I know people personally that have lost money, not because of the tax credit, but because the actual oil deal went south. So what would be your 2 cents on just the due diligence to make sure that you're doing
first of all, don't ever let the tax tail wag the investment dog.
Yeah.
Okay. You make an investment because it's a good investment. Yeah. It's going to produce cash flow. But don't forget the tax side of it. So you're looking at what's my after-tax return on investment versus my after-tax return on investment. So for example, you invest in the stock market, you get no deduction up front. So and then your income is probably either capital gains or dividends. So you're getting probably a 20% tax rate, right? Okay. But no tax deduction going in. And then when you sell it, or you get dividends, you pay tax. On, say, oil, you're going to get, say, 40% of your money is going to be contributed by the federal government. So that means you're after tax, you're really only investing of that $10,000. Think of it this way. You're really only investing $6,000 or $7,000. And so your return on investment is that much higher.
Yeah.
So it just increases your return. It doesn't cause your return.
Thank you. And again, it's just like any of this stuff. It's like real estate's a great example. Just because real estate's an amazing asset.
A lot of people are losing money on real estate right now.
But it doesn't make it just a Band-Aid and everything goes away.
Right.
So, and then would you say agriculture is like, what's the potential investment
that is the best. By the way, of all of them, agriculture is the best.
Amazing. Okay. I got my notebook.
I've just never met a farmer or rancher who pays tax.
Yes. Okay.
Sell me.
I'm from Wisconsin, and there's a lot of farmers that I wouldn't trade places with.
No question. What is the most important commodity that is produced in any country? Food.
Food. Yes.
Right? Food. And so plus, what is the most risky business in the world? Agriculture.
Yes.
So you take those two together, and the government's just saying, look, we're going to give you all sorts of incentives to do this. There are specific incentives for different types of crops, which is bizarre to me, but there are. I mean, like Christmas trees. Did you know that you sell Christmas trees? It's capital gain. Okay. It's not inventory. It's capital gain.
Interesting.
But you get to deduct all of your investment you get to deduct, right? So you're deducting all your investment into the seedlings and into the fertilizer and into taking care of them. But when you sell them, you get capital gain. So I actually use this example in the book is as a Christmas tree farm, or a winery, right? A winery, you put all that money in, it's high risk. I mean, you think about those wine producers in Napa Valley, and when all that when they had the big fires, and they lost whole crops because of that. So it's a highly risky business. It's a highly risky business. The government's just basically saying, we'll let you make your money. We're just not going to make you pay a lot of tax because we want you to do it.
If you don't want to invest directly in like a farm or a winery, is there a world where you can like oil and gas and put some money, but still get the benefits of tax?
Yeah. I mean, you'd have to find a farmer or rancher who was expanding that needed capital.
Got it.
And was raising money. So it'd be that kind of an investment.
Okay. Let's talk about life insurance. Obviously our
audience. Let's do it.
Our audience knows a little bit more than the average person as relates to life insurance. Your buy, borrow, die also relates to this in almost
absolutely
an amazing way. But I just want to from your perspective, what is your thoughts on using life insurance as an asset?
Hey, it's Caleb Williams here. I'm just interrupting this video quickly to invite you to check out our And Asset Vault. You may have been there. We've actually revamping it. And if you are somebody that wants to learn more about, is life insurance the right fit for me? Does this and asset make sense? Does this actually help me be more efficient? We've put together a 10-minute documentary style video that I think does a really, really good job giving the history, why the and asset, different setups and designs that we use. And then we have an and asset vault that gives case studies, calculators, handbooks, and so much more. We are here to serve you, whether it's a conversation, whether it's education, or the video. So make sure to go check out andasset.com/vault. Learn more.
You call it an investment. I almost see it as a storehouse to be able to invest in other areas that you've talked about in this book.
So there's a lot of reasons for life insurance. I don't think there's just one reason. And a lot of people like me, I will probably never use my life insurance policy for a loan. I probably won't.
Yep. Okay.
I don't need to. Okay. And, but I'll tell you what some of the great tax benefits are, of course, is first of all, it's public policy is what allows life insurance all the tax benefits. It's that, look, we're trying to take care of widows and children. That's really where it comes from. And it's good public policy. It's not unusual in different countries, although I think we're a little more aggressive with it than most countries. And, but you have, of course, two types of policies. One is a term policy. One is a permanent policy. I'll call it permanent. There's whole life, et cetera, but it's a permanent. And the way I explain the difference is one's an expense and one's an asset. And that's really, somebody once explained to me, in fact, somebody I know, I'm sure you know, Patrick Donahoe.
Yeah.
One day he was telling me, he goes, I said, what percentage of term policies are collected? He says, less than 1%. What percentage of whole life policies are collected? He says, over 97%. I'm going, okay, so here's what you're going to say from now on, Patrick. Term is an expense and whole life is an asset, because that's the case. Now, if you just want to have an expense, then term is fine for you. But what I think there's some really good uses for whole life. One is, of course, is you've got that cash surrender value, and if you need that loan, you can always get that loan. Okay. Another is, of course, is that it means that if you want to take care of people when you die, that means that you have an asset and you can spend all your other assets, and you don't have to worry about leaving your assets and living less of a life, so that your assets can take care of them. You can let the life insurance take care of them. And I think that's a huge one. From a tax standpoint, there's no deduction to buy life insurance. However, yes, there's no income when you receive, the beneficiary gets the life insurance. There's no income. Certainly when you borrow it, buy, borrow, die, there's no income. On top of that, though, if you use this collateral, because again, you're not borrowing from the policy. You're using the policy as collateral for the loan from the insurance company. That's a very big difference. then people know what the reason this is important for people is if you, let's say, borrow from your Roth IRA, the interest you pay your Roth IRA is not deductible because it's not taxable. So that's a non-deductible interest expense. With life insurance, though, you're not borrowing from your policy. You're borrowing from the insurance company with the life insurance as collateral. That means that if you use that money for, say, real estate or for business, the interest is deductible as real estate interest or business interest. And so while the interest income, see, this is what I love. The interest income is tax-free because the policy is still growing. And the interest income on that policy, if you hold it until you die, is tax-free. But the interest expense is tax deductible. So you actually get some tax leverage here by borrowing by borrowing that money. And you don't lose anything, but it's a debt like anybody else, and you are not paying yourself. You are paying the insurance company.
That's right. And a lot of people mix that up. They make it almost sound too good to be true. And it's two separate. It's like your cash value and your death benefit are growing pretty much regardless. The fact that you utilize your policy, you want to make sure that activity makes sense as well. It's not just all in one bucket.
For sure.
You are, there is a debate, and it's interesting because it's like a lot of things in tax. It's not super black and white, but you're saying even there's some people that say you have to have a third party lender to have it be tax deductible, but you're saying not. If you can prove that it's business purposes and you're working with the insurance company, you can write off that interest.
No. So here's the rule. And I tell you, I was in the national office of Ernst & Winnie back before it was Ernst & Young when the interest deduction rules came out. And we actually testified before Treasury on these interest deduction rules. Okay. And I got really, so I have firsthand knowledge of how these interest deductions rules work. It's a tracing principle. So you actually, any loan outside of your home mortgage, the deductibility of that interest depends on what the money was used for.
Got it.
Okay. So in this case, the reason you don't need a third-party lender is because you're not borrowing from your policy. You're borrowing from the insurance company. And the insurance company is a third party.
Yeah.
You're not borrowing from yourself like you are with a Roth IRA or a Roth 401k, Roth 401k. You're borrowing from the insurance company, a third party. So I don't think there's any question it's deductible.
And I think there's just so much misunderstanding as it relates to that because most people don't even use language well. And so of course, people might get it mixed up to say it's just like your Roth IRA, but you're totally right. There's a third party there. So yeah,
it's not at all like your Roth.
No. And I again, appreciate you writing this in the book and even just your understanding around it, because as you know, that sometimes life insurance gets a bad rap, rightfully so, by the way. There's I don't endorse, neither do you, all the things that happen when people talk about life insurance, but it can be a great asset.
Well, and I got to tell you, I think the most creative people on earth, besides lawyers, are life insurance people, because they keep coming up with new ways to sell life insurance, and it just cracks me up. I'm going, oh my heavens, some of these things that they're saying work, they don't work. Okay. And so just because life insurance doesn't mean it works.
Yeah.
So you do have to make sure, particularly some of these more extravagant things. A big term right now is PPLI, right? Private placement life insurance. There are situations where that works, but there are a lot of situations that are being proposed by aggressive life insurance agents that do not work. In fact, the IRS is going after them because of that.
Same thing with people borrowing money to pay life insurance. It can work based on your situation, but all the people that were pitched these sexy illustrations, and now with interest rates going up, it's it becomes very problematic. Last but not least, you have retirement savings plans. Yes. I want to again thank you for just spending the time, and this has been amazing. there's a lot. I have like a list of like, hey, we're going to have Tom back on and we're going to talk about the TikTok tax things that make you want to throw up or other things. But I want to just end on this note, and then hopefully we can have you back on and jam about some more things. Yeah.
Let me put it really. So one thing I learned, probably the most important thing I learned writing this book, was that IRAs and 401ks do work from a tax standpoint, because what happens is you when you get a deduction, it comes off your highest rate, but when you get the income, it's spread over the different tax brackets. So I do want, because I kind of had to eat my own words on that, because I said for years and years, it doesn't make any sense unless you want to retire poor. That's not really true. If you retire with the same amount of income as you had when you were working, you're still better off, net better off. Okay. I want to be really clear on that. But the second thing that I want to be clear on is that investing in the other 6 as a retirement plan is far better than investing through an IRA, 401k pension plan, usually. And the reason is because you get that big tax deduction up front, and buy, borrow, die. You may never have to pay the tax. So on the IRA, you're paying tax at some point. Either it's a Roth IRA and you pay tax before you put the money in, or it's a regular IRA and you're paying tax on the money when it comes out. So one way or another, you're paying tax. In real estate, you may never pay tax. Yeah. Same with oil. You may never pay tax. I mean, some of these other investments, you may never pay tax. Your business, I can show you how to start a business, build a business, sell a business, never pay tax. Yeah. So just know that while yes, it works, it doesn't work as well as the others. Yeah. No, I appreciate you saying that. I agree. And it's interesting. You can say that. And then we also, what we even opened up the show, if people raise taxes in the future, you're postponing. You're deferring into a higher bracket. Yep. And the fact that inflation is happening potentially means, again, you have to spend more money just to maintain what you're currently spending today, which potentially means you're going to be paying more taxes. But you're 100% right. And deferring versus paying, there is momentum that gets built up, and for sure. And so, Tom, thank you for taking time to write. Thank you for taking time to set the record straight. And I will also include your YouTube channel and any other links that you want me to have. And if there's any call to actions that you have, we'll have your books, your YouTube channel. If you watch me, you're out of your mind if you're not going to go subscribe to the tax goat himself. But is there any final words that you want to leave our audience? Yeah. First of all, website is tfwadvisors.us. So I will throw that out. But the most important thing is don't be afraid of it. Most people are scared to death of money. They're scared to death of finance, mostly because they've been taught to be afraid of it. Taxes is perhaps the scariest. And, people go, well, death and taxes, right? They're both inevitable. Well, taxes are certainly not inevitable, and death is becoming less and less inevitable. So, but taxes are definitely not inevitable. And so it really comes down to getting educated so that you have a choice. Now, you don't need to be educated in all the details. That's what your tax advisor for. That's why we have our franchise of tax advisors, is so you don't have to know all the details. You do have to understand the principles, which is why I wrote Tax-Free Wealth and Win-Win Wealth Strategy, because it has to become a strategic decision for you as to what am I going to do, and because if you are willing to take charge of your life and your finances, then you can way more money still by paying a lot less tax. It's how many fiction books or books in general can you read and know that by knowing these facts and information, the compound effect? I can't think of a better compound effect than understanding the tax code as it relates to how you make money and how you invest your money. Tom Wheelwright, thank you. And until next time, we will include the information, including your website, down below.
And I'm grateful for you. And I hope you have a safe, eventful, hopefully not too eventful rest this year.
Thanks a lot, Caleb. Appreciate it.